What is up, everyone? Welcome back to the channel. It is so good to see you back here. If it's your first time, come on in. The water's fine. We're going to have a good time. We're going to have fun. I was just looking at this a minute ago. We have people watching from Canada, Australia, Germany, the UK, Sweden, Netherlands, Denmark, Norway, France, Taiwan, South Korea, and of course the US. So it's so crazy that people all around the world are checking out this channel and enjoying it. Thank you so much for giving me a little bit of your time. I appreciate it. I hope it pays off big for you. And be sure to subscribe. And this is the official channel, so you may as well subscribe to the official channel. And with that, assuming you've subscribed and you're ready to go, let's get started. So I'm going to go through this thing in one take. It's going to be a one-take McGillicuddy. I'm calling it a one-take McButterpants. I'll cover everything. It'll be a 15-minute video. So what I want to do is spend about, actually, let's just do 9 minutes. Okay, 9 minutes. And then we'll leave 4 or 5 minutes at the end. So the two parts are going to be, one, I'm going to tell you about a stock that I like. We're going to go over a brief sketch of it and just kind of determine whether or not it's potentially interesting and warrants some further investigation. Some of you might know it. I'm guessing a lot of you won't, because it's a little bit under the radar, which is fine. And then I'm just going to go through some fundamentals of investing, like just stuff that I look at, rules of the road, evergreen principles. And then at the very end, we'll just spend some time going to some like free websites and some free resources that you can use to build up your own mini Wall Street model so that you can value any company really easily. And you don't need anything for this. You don't need a pen and paper. You don't need a calculator or anything else. Just sit back and enjoy it, because we'll be talking about this stuff a lot. So it's better just to kind of take it in. And I should probably make this 8 minutes now. I'm talking too much. Okay. So let's get started. So I made this little outline, but at the very bottom are the two stocks, because I figured you guys would want to get right to those. So they're kind of cloud / tech stocks. I picked two of them. I own both of these. And let's start with Domo. So I pulled this up, and this is the price of Domo. So this is May 2019. The stock peaked at 44, and the stock's at 25 right now. It had a couple of big disconnects on earnings, some disappointing earnings reports, and it's recovered somewhat, but I don't know a lot of stocks that look like this, that are basically this far off of the highs from 2019. I mean, most stocks are on their 52-week highs. So unless something is seriously broken with this company, it could be interesting. You know, maybe not. Let's look at the valuation. So this is enterprise value, and I'll explain to you what enterprise value is. If you don't know already, that's fine. It doesn't matter. On an enterprise value to EBITDA basis, it was trading at 7.5 times revenue, and now it's trading at 4. So not only has the stock gone down, but like the valuation's gone down too, which is interesting. So we've had sort of like a double whammy, where basically the valuation has compressed to a level that was much lower than it was, at least at its highs. It looks like maybe the average is, I don't know, I'm eyeballing it, but maybe 5-ish times. If you do a little bit of Google work, you will see that they have a couple of competitors, and you can do this easily for free, but I already did it, and we'll talk about some of this stuff later. It's not really important right now. But one of their competitors is Looker, and Looker was actually purchased by Google in 2019 for $2.6 billion. And Looker was generating sales of 140 million. So let's go here and see what that implies. 2.6 billion over 140 million is a multiple of 18.6. So boy, that is a big discrepancy between 4 times and 18 times. By the way, what do these companies do? They provide business analytics software for business managers and CEOs, basically to walk around with an iPad or their phone or a computer and monitor in real time different stats that are coming out of their company. So they sort of do similar things. Salesforce acquired Tableau, which is sort of another business analytics company, for 15.7 billion. It was a stock deal, but that doesn't matter because they still got a price. And so 15.7 billion and sales of 1.4 billion. So that's like 11 times or so. So we've got two potential peers. One was purchased for 18.6. The other was purchased for 11 times. And then we've got our little Domo here trading at 4. So what's happening? Who is the Domo CEO? Look at this guy. He looks nice. He's got a brown suit and he's in good company. People who search for him also search for Steve Jobs, Walt Disney, Jeff Bezos. That's an interesting group of people. So let's just see who this guy is. He's in control of the company that you're looking at maybe potentially buying shares in one day. So he's the CEO of Domo. It's a SaaS company. We know that. He previously co-founded and served as the CEO of Omniture, a web analytics company. So let's just go down here and see what happened to Omniture. Did they go bankrupt? Were they trading at 4 times EV to revenue and then they folded? Oh, no, they were acquired by Adobe for $1.8 billion in 2009, which is also a pretty difficult market environment. Okay, so the guy founded a tech company that was sold. And he's running a company that is in the same industry as these 2 other companies that were just sold to very savvy acquirers. So I don't know yet. At this point, I'm just thinking I would like for somebody to explain to me why the valuation discrepancy exists. Obviously, there's an M&A premium that you have to think about. There's product fit and match and all of those things. Maybe they just make a terrible product that nobody wants to buy. But we know somebody's buying it because let's take a look and see if they have any revenue. Yeah, they're generating, according to this, 142 million of revenue. So somebody is buying their stuff. And likely that subscription or that revenue or that customer ARR is worth something to somebody. Does that make sense? A little bit of sense so far? Okay, so let's go to the fundamentals of sort of stock investing. And again, this is not advice. I can't stress this enough. Do not listen to me or anything that I have to say. I really do not know what I'm talking about. This is for learning purposes only, and I am being serious about that. This is my disclaimer. So there we go. Okay, so markets and stocks, no incrementalism. What does this mean? To me, what it means is if somebody pitches you a stock, you don't want them to say, hey, you should buy Tesla because it's better than Ford. Or you should buy GM because it's better than Ford, or you should buy Apple because it's better than Microsoft. Well, that doesn't really tell you anything about the underlying fundamentals or the valuation or anything else about the company, really, when you think about it. So really what you want somebody to do, for example, if they're pitching you on Tesla, you want them to say, hey, I think they can sell this many cars, and I think the price of the cars will be this, and they'll be able to do it at this margin. That equates to $1 per share number, and you can put an EPS multiple on that and derive a stock price. And so it's not just based on these theoretical things, it's grounded in some amount of reality. That I think is really important. And all stocks go to the same place, but none ever trade the same. What does that mean? It means that ultimately every stock is priced based off of its future earnings potential. Every single one, whether it's an oil company or a healthcare company or a tech company or an industrial company, whatever, all based off of the future earnings. The market discounts the future, not the past. Now, they have different paths because some stocks and some companies are in cyclical industries like industrials or maybe like airlines. Others are just in secular growth industries, maybe like healthcare or like tech. So they will trade based on different news items, different fundamentals, different policies and things like that, depending on the country that they're in, but they always go to the same place, which is the market's future expectation of their earnings. A real quick, I see that we're coming up on our timer here, so let me just stop that, and let me stop that, otherwise it'll, okay. technicals here, I'll just skip over because we don't have a lot of time. The bottom line is that I do think some technicals are valid, and if you want me to do a video on it, I will. The very simple reason is that humans repeat the same patterns over and over and over again. I have an investment book called The Technical Analysis of Stock Trends, which I purchased and is out of print, but it was, I think, made in like 1950. And it's crazy because if you look at the stock charts that they have in this book, they look like they were written yesterday because these same patterns repeat over and over and over again. I'm not a technician, but it's interesting to see how people trade stocks. And if you have a fundamental grounding plus a little bit of technical training, that can be, potentially helpful for you. So develop your evergreen toolbox, market cap, enterprise value, shares, Wall Street estimates. We're about to do that in 1 second. Protect the downside. I've gone over this before, and I put it in caps because it honestly is probably the most important thing, but let's just keep going. Hedge fund wizardry is probably worth spending 1 second on. So a lot of hedge funds make money this way. Let's say you have $100,000 and you tell a manager, you go 3 by 3, meaning they put 300,000 on long and 300,000 on short. They're doing them with bigger numbers, but let's just say 100,000. And let's say the market returns like on average 10% a year. And they say, don't do anything risky. We just want you to make like 5% on the longs, roughly. Okay, so 5% on $300,000 is right here, 15K. And maybe they make a little bit of money on the short side as well. Say half that amount, 7.5. And then they get charged, let's say 2% for the 500,000 that they're borrowing, right? Because they put up 100,000, they're levering up with another 500K, and they're being charged 2%, which is, did I do that math right? Yeah, I did. 2%, which is $10,000, which represents that 10% on 100K. So this is how a hedge fund using leverage can reduce their volatility because they have longs that are offsetting shorts and vice versa, but come up with a better return than the market. Theoretically, it's been pretty hard to do these days. Mental math is important. We can skip over that for now. I wouldn't recommend doing this unless you have access to a lot of tools and resources and you're willing to work like 12 hours a day plus weekends and you have access to leverage. But the good news is you have advantages over all the other hedge funds because you can use things like concentration. And you can really sit back and wait for 1 or 2 fat pitches. Like you only need 1 or 2 good ideas in a whole year to blow the professionals out of the water. Let's say you were sitting around, you had 100% of your money on the sidelines, but you bought Tesla in August of 2019 when it went below 200 a share. You would blow the the doors off that 12.5%. Okay, guys, I was worried I'd go a little bit long, and I did. So I have 1:30 set up. All right, that's started. So let's go into the capitalization table for Domo now. And I pulled up these websites so we'd have a little bit more time to talk about some of this stuff. I think one of the most critical things, I never see people go over this, you have to figure out the correct number of shares that a company has so you can figure out what you actually own. So they're telling us they have 26.3 million shares. So let me type that in. Let me verify that share count by going to the latest 10Q, where they always post their shares on the very first page. So they say we have 24.6 million Class A shares or Class B shares and 3.2 million Class A. So 27, 28. It's pretty close, but the point is we're probably not missing anything huge. Okay, so we need the stock price in order to get the market cap. The stock closed at $24.97. So I'm going to type that in. Now we have our market cap. Next, in order to get the full capitalization, I went to their investor relations site and pulled up their latest quarterly filing. In October, they had 93.5 million of cash and 22.5 million of short-term investments. I'll include both of those. Represents the company's cash position. They do have some long-term debt, which looks like is 100 million. So they basically have a net cash position. Guys, so we ran out of time. I was worried that might happen. I'm going to post a follow-up to this video probably early next week, and I'm going to leave a link in the description and describe how you can get the very last pieces in order to put this puzzle together and confirm that Domo's trading at 4.5 times. And the reason that I think it's important to confirm the valuation independently is so that once we know those numbers, we can now go ahead and unpack and confirm and look at, hey, why is Domo so different from those other two companies? Are we missing something, or is the market missing something? Thank you so much for watching. Be sure to subscribe. This is the official channel, and I'll see you next time.